Hello guys, this is Mikael Roby Coleman and I'm with Tempo Financing, and here on this channel we teach you guys how to eliminate your debt quickly. I want to thank my Lord and Savior Jesus Christ for being here to explain to you guys today the lesson that's about to be taught. So today I'm going to be explaining the difference between loan interest rates and explaining the difference, contrasting it with line of credit interest rates. Okay, so let's get into it. Loan interest rates. I came up with a example or some type of correlation with the metric systems, and with that being said, let's take a dive into that. For instance, 105 degrees Celsius is hotter than 212 degrees Fahrenheit. I put this correlation up because it goes perfect with dealing with loans and line of credits, because a loan give off the perception that since it's a lower interest rate that it's better, and that's not the case. Just because a loan interest rate is lower, that doesn't mean that it's better than a line of credit interest rate. And I'm going to get into that further right now in this video. So just like in this case, just because you see 105 degrees Celsius, that doesn't mean that it's not hotter than 112 degrees Fahrenheit. If you notice in this video, we're talking about different systems. In the metric system, we're talking about Celsius and Fahrenheit. Celsius and Fahrenheit is two different measurement systems that measure temperature differently. Same thing with the loan and a line of credit with their interest rates. A line of credit interest rate is higher than a loan interest rate, right? But that doesn't mean that the line of credit interest rate is worse than a loan interest rate. So let's get into it. With a loan interest rate, I came up with an example of a home, a mortgage, right? The home is $300,000, right? The home is $300,000, and the interest rate is 6.25, 6.25% interest rate. That's what the going rate right now in America is in 2025, around 6.25. That's where we at right now. So I did 6.25. And we all know that mortgages are between 15 to 30 years. So I went with a 30-year mortgage. And if you download, go and download the Carl's mortgage calculator. Carl's mortgage calculator. Go download that, and you'll be able to input these numbers, and you'll be able to see the same numbers that I'm seeing right now. So do that at your earliest convenience. So the payment for this $300,000 home at a 6.25% interest rate is $1,847.15. That's the payment, and this is not including insurance, and this is not including taxes. So, disclaimer: that's not including insurance, and it's not including taxes. So remember that. So now, this is the part. In interest alone, hear me, in interest alone, this person will be paying $646,000, $646,974.58 in interest alone. How much is your house? Your house is $300,000. You're paying more in interest than actually paying for the home. This just in interest alone, just interest. So this money right here goes to the bank. So what you're paying in interest, it goes straight to the bank. You have just gave the bank a brand new house. You, with your hard-earned money that you work for, you have gave the bank a brand new house, another house. You just gave them another house. They just doubled up on you. You just gave them a brand new house at $364,974.58. Now tell me that something's not right about that. In total payments, these are just your payments. These are the total payments that you made from year 1 to year 30. You paid $664,974.58. So total in all, you paid for 2 homes. You paid for 2 homes. 2. From year 1 to year 30. Let that sink in. Paid for 2 homes. The bank got you out of 2 homes. You doubled up. You don't see nothing wrong with that? You don't see nothing wrong with that. And guess what you did it on? You did it on a 6.25% interest rate. You don't see nothing wrong with that? There's something wrong with that. They have stripped you out of your interest. You pay for a brand new house, another brand new house, just off the interest. You gave the bank a brand new house just off of interest. Your house is only $300,000. In interest, you pay more in interest than paying for the house. So let me come over to this side, to the line of credit interest rate. Line of credit interest rate is based off the average daily balance. And here in this example, we have a 15% interest rate. 15% interest rate with a line of credit, right? And this 15% interest rate, I'm gonna ask you at the end. I'm gonna save it. So you have a 15% interest rate, and the way that you calculate average daily balance is you do interest rate times the balance divided by 365, because it's 365 days in a year. So you have to divide it by that. You'll get that answer. And then you turn around and multiply it by 30, because it's 30 days in a month. Some are 31, but everything we just gonna go with 30. So it's 30 days in a month. So you turn around and times it by 30, and that's how you get your average daily balance, your interest payment for the month. Okay, this, like I told you in the last video, this is a simple interest tool. This is a simple interest tool. So we know what average daily balance is. We know how to calculate it. This is how to calculate it. And then you have the simple interest tool. So let's say that you have a $10,000 line of credit, right? And you pay $4,000 in expenses, right? 10 minus 4, 6 is 6. So now you have a $6,000 balance, right? Right? But the main question is, Nikhil, do I have access to the same 4,000 that I put in? What you think? Do you have access to the 4,000 that you just put in? Do you have access to that? The answer is yes, you do. You do you have access to $4,000? Yes, you have it. The same money that you put in is the same money that you can take out. That's what makes this so beautiful. And guess what your interest is getting charged on? Your interest is not getting charged on the $10,000. Your interest is getting charged on the $6,000. Now, you are looking at this video. You can calculate what the $6,000 is. Only thing you gotta do is plug the $6,000 into where balance is and go from there. And just follow the step, pop, pop, and you will get your payment, right? So don't forget how to calculate percentages, right? When you put it in the calculator, it'll be 0.15. So you do 0.15, which is 15%, times the balance, divided by 365, and then multiply by 30. And that'll give you your average daily balance for the month. Hold on to your seat when you see that number, because it's going to be extremely lower than what you're dealing with over here. You're paying over here, you're paying $1,847.15, and that's getting split up. That's going to be front loaded. Most of this is going to here. That's why you can pay for another. You're paying for another house, because this payment is going mostly to here. Most of it is going right to here. I guarantee you, maybe out of this, maybe $1,200, $1,300, maybe $1,400 is going to this, and the rest is going to the principal in a loan. But in this case over here, you're only getting charged 15% based off the balance, which is $6,000 over here. So the $6,000, you only get charged 15% based off of that. That is the key to a line of credit. You're not getting charged based off 15% of what's going on with the $10,000. The $10,000, you're getting based off of the balance of it. That's what makes this so unique. That's what makes this so valuable. That's what makes this tool so strong. A line of credit tool is stronger than a loan. Now I got a question for you. What's better, right? 15% or 6.25%? You tell me. Okay, good job. 15% is better. You're right. The 15% is better than the 6.25%. It's just like this example, right? 105 degrees Celsius is hotter than 1212 degrees Fahrenheit. So let's look at it from the interest rate standpoint. This loan is Celsius, and the 15% is Fahrenheit. You get what I'm saying? Like, this is what it is. Like the metric is all about optic illusion. They get in your eyes with manipulation. But I just made it simple for you just now. 6.25%, that's Celsius. That's Celsius. And the 15%, that's Fahrenheit. And we know the truth of the matter is that this 105 degrees Celsius is hotter than 212 degrees Fahrenheit. But if you would have asked somebody else, just off optics, they'll say 212 degrees Fahrenheit is hotter than 105 degrees Celsius. Off optics, just off looking at it. Nobody really wouldn't say, oh, 105 is hotter. No, they wouldn't. They're gonna say 212 is hotter because it's more than 105. Same thing in this situation with interest rates. People look at People look at the 6.25% and think it's better than the 15%. People look at the 6.25% from a loan with a 30-year mortgage and think that it's better than a line of credit with a 15% interest rate. No, it's not better. So the message is, know what you get yourself into. Know what you are doing. Get educated. Take control. Educate yourself. Educate yourself. Educate yourself. I cannot say it enough. Because a lot of people right now, they're gonna bite the loan because they see 6.25% every time. They're gonna do it, but they don't even know the structure of it. They don't even know the infrastructure of this loan. They don't know what's built inside this 6.25%. They don't know. And just because they see the 15%, they like, oh no, this is higher. I don't want that. I don't want that. But they don't know how it's built. They don't know how it's structured. It's structured completely different. These are two different systems. This is a Celsius system. This is a Fahrenheit system. The reason why I put a loan, right? The reason why I put a loan as Celsius is because it represents hotter. And in my case, hotter represents more expensive. When something is more expensive, to me, it's hotter. When something is more expensive to me, that's cold. I like that. We call that cool in this generation. Oh, that's cool. Something that's a low price but full of value, that's cool. Something that's expensive with no value, that's hot. I don't want that. Beware. Whoa. Right? So we are dealing with two different systems. This system is better than this system. The line of credit system is better than the loan system. 15% is better than a 15% interest rate with a line of credit is better than a 6.25% interest rate with a loan. With a 30-year mortgage. Fixed. So let's get to it. Lines of credits have higher interest rates than loans. But the key to it is structured differently because it's based off simple interest and it has an average daily balance. Compared to a loan, right? A loan has an amortized schedule. It's amortized and it's fixed. And they split up, the system, the lending institutions split up the payments between interest and principal and front loaded with interest so that they win. This is a recipe for the consumer to win with a line of credit. This is a recipe for the banks and the lending institutions. That's for them to win. I want to leave you with this. At the end of the day, McDonald's is a real estate company that sells burgers. Car dealerships are lending institutions that sell cars. Banks are lending institutions that store money. That's it. Let's just break it down to the lowest common denominator. Let that sink in. So when you go to these car dealerships, the first thing they want to do is get your car financed. And when they pull your credit, they're going to take the lowest credit. They're going to take your lowest credit score because they're trying to leverage the interest to give you the highest interest so they can get the highest money in their pocket. So don't be fooled. When you go and get a mortgage at a bank, they're gonna do the same thing to you. They're gonna take your lowest credit score to leverage you in interest. And then they're gonna put you on an amortized schedule for 30 years. And then they're gonna manipulate you for 30 years. The definition of mortgage is death age. Mortgage. Mortgage. Mort stands for death. M-O-R-T equals death. Mortgage. Gauge equals pledge or age. So when you sign a 30-year mortgage, you're signing a death pledge. A death age pledge. Right? So let's continue to educate ourselves. Right? So let this example serve you well. Replay this example. Replay this example. Download the Carr's Mortgage Calculator. And lastly, go to www.tempofinance.org. If you want to call, we can set up a call. We can talk about your situation. We can do a personal assessment on your situation to get you on the road to your financial freedom. Continue to watch the videos. I thank you for tuning in, and I will see you at the next video.